I came across this article from Robert and Sam Kovacs here on Seeking Alpha, and it's titled Start Investing at 60 and Retire on Dividends Forever. Now, there's a lot of things that I like about this article, and towards the second half of the article, I just kept scratching my head, asking the question, this doesn't make sense to me. I don't agree with what they're saying. And so I've read an article and shared an article on the channel from them before, and I think their last article, I think I gave them an A. And so I was really excited about this article, and after reading it in preparation for this video, there's a lot to like and a lot to not like. And so if you're 60 years old and don't have a lot of savings and you're late to the game, they offer a lot of great advice, but a lot of also, in my opinion, bad advice. And I want to talk about that in today's video and share with you my thoughts and opinions on what they're sharing. And I want you to put on your thinking cap, and I want you to use critical thinking for yourself and to determine for yourself if what they're saying and what I'm saying, if it resonates with you or not. And something that you'll notice, there's a lot of different ideas, strong opinions, and you just kind of have to figure out what works for you and understand that investing is personal, and you have to go with what you're comfortable with and something that you can understand. So with that, let's go ahead and let's take a look at the article. And it starts with a summary saying here, starting late in investing doesn't mean you can't retire on dividends. Building a high yield dividend portfolio can still secure your retirement. Focus on quality dividend paying stocks with a target yield of 6%, balancing yield and growth to maintain principal and generate income. Avoid spending principal by investing in high quality, undervalued stocks with growth potential, ensuring long-term financial stability and leaving a legacy. Use a strategic approach, buy low, sell high, and get paid to wait, leveraging quality, value, growth, and momentum for optimal returns. We are Robert and Sam Kovacs. So they have an investment group here on Seeking Alpha. And so a couple initial thoughts that I wanted to share is, the title of the article here is Retire on Dividends Forever. And they have a good portion of this article based on buy low, sell high, get paid to wait, and, different metrics of how they, evaluate stocks on different things. And so I guess that's fine, but the thing that I'm kind of troubled by this article is if you're 60 years old and you haven't invested anything, or you're late to investing, it means that you're a very new investor, or you haven't been in a privileged position where you've been able to save, or you may be, and this is not an insult by any means, you are likely financially illiterate. And that is very, very common here in the United States and across the globe. Financial literacy it's not something that every human being is born with. It's something that you have to take time and learn if you're not in a household or a circle of friends who talk about finances and investing. So the thing that I'm most critical about this article, if I can say so, is this article is addressing new investors, someone who is late to the game. And so by definition, the correlation here is that you're talking to people who are not financially literate and are, probably behind in terms of, their understanding when it comes to investing. And so if I were to create a video on this topic on my channel, I would make sure that I understand that the audience probably doesn't know truly what compound interest really is. They don't understand the rule of 72 and a lot of these different terms. And in this article, misses the mark for me in that regard. So I just wanted to share my thoughts and opinions on that, because if you're 60 and don't have savings and you haven't been investing, it's because this is a foreign topic to you, which is okay. But it's important to understand, you got to start somewhere. And so he starts the article off with a quote from Warren Buffett: "Someone's sitting in the shade today because someone planted a tree a long time ago." I love that quote from Warren Buffett, by the way. I think it's great. I love Warren Buffett quotes. The man just has a way of explaining complex concepts with easy metaphors. In the opening quote of this article, time is the clear differentiating factor between having shade to sit in versus burning out in the sun. And many believe that investing is the same way. Over the past 4 years, running the Dividend Freedom Tribe on Seeking Alpha, I've had many individuals in their 50s and 60s tell me they wish they had started earlier and had the luxury of time. I hear that all the time too. In my Review My Pies, when I read emails, they're like 21 years old and they're like, I wish I started when I was 18. Like I wish I started in the womb, right? Like everyone wished they started earlier. As soon as they learn about compound interest and that your greatest asset is time, obviously the best time to have started would have been yesterday. The second best time is today. Okay, moving on here. As Shakespeare once said, better 3 hours too soon than 1 minute too late. But if you're a regular American at 60, you might be wondering, did I miss the boat? They feel that maybe living off dividends might be what? I think that might be an area. Might be what? And here we would be advised to take Antonio de Saint, I can't pronounce that. Some historic guy, sure. Advice. The time for action is now. It's never too late to do something. I'm not cultured, guys. I don't know every historian's or philosopher's name, and I can't pronounce them. I don't have culture, okay? Don't make fun of me. Okay, I went to public school. Stop making fun of me. I can't pronounce names. And and I believe this. Okay, pull it together. If you want to retire on dividends, if you're coming late to the game, you can still make it work. In this article, I'll be looking at a typical American newbie investor. So he is mentioning here that he's talking to new investors. Okay, so keep that in mind. We're talking to new investors. They're 60 years old, is who we're talking to here, who probably don't have a solid foundation when it comes to, investing and financial literacy. Meet Tom and Linda. Tom and Linda are both 60 years old. They live in a suburban area in Indianapolis where Tom works as a manager of a local manufacturing plant. Linda works part-time as a receptionist at a medical office. Together, they take home $77,000 per year. While they would like to retire at 65, so in 5 years, they are coming to terms with the fact that Social Security might have to make up a bigger part of their income. Tom has about $120,000 in a 401k. They currently spend $50,000 per year, of which $15K goes towards their mortgage, which should be fully paid for in 6 to 7 years from now when they plan on retiring. They expect that if they retire at 67, they might get a combined $3,000 per month in Social Security or $36K a year. Although they won't have to cover the mortgage anymore, they'd like to bring home about $50K in retirement so they can afford some travel and a few hobbies, as well as to plan for any unexpected health expenses. This is America after all. That means that they need an extra $14,000 per year to cover the gap. They want this to come from their nest egg. They're currently saving $500 to $700 per month. They expect that by retirement that they might have $170,000 in Tom's 401k if they continue at this rate. Tom ran a retirement drawdown simulation and realized that they would be effectively going from $170K to zero in 23 years after retiring if they were to withdraw $14,000 per year while growing his portfolio at 6% per year. That's what he heard he could safely average in a mix of equities and bonds. Something felt wrong about this. For one, they're concerned that they might just live beyond 90 and at that point run out of cash. Furthermore, Tom wants him and Linda to be able to leave something to their kids when they pass. Spending all their savings in retirement seems like they'd be wasting everything they spent a long time building up. Surely there has to be a better way. Tom all of a sudden feels a feeling of urgency about his retirement, as do many individuals when the big 6 comes around. He starts reading some personal finance books, some investing books, and lo and behold, he lands on Seeking Alpha, where he discovers me and my father, Robert. What we preach is simple. Rather than spending your principal, build up a portfolio of dividend-paying assets so that you can live off of the income and let the principal grow by itself. I love that. I love that. That is what resonated for me when I was looking at this whole thing, when I was trying to figure out how I wanted to retire, what I wanted it to look like. The idea of selling my shares in retirement was the last thing that I wanted to do. And then I stumbled across dividend investing, and it's just been a great experience ever since. And I'm sure many of you out there can relate to that. Once you find dividend investing, it is an incredible thing. And so Tom uses one of our tools to plug in his current plan, which is to be able to generate $1,200 in monthly dividend income within 7 years by investing $120,000 into dividend paying stocks and adding $700 per month. This is what the calculator tells him. So this is kind of like the dividend reinvestment calculator that I talk about on my channel. I guess it's got to be very similar. To reach his target within 7 years, if investing in stocks with an X% yield, he would need to grow the dividends at a Y% growth rate. So 2% yield and a 30% dividend growth, 3% yield and 19% dividend growth, 4% yield, 12% dividend growth, 5% yield, 6% dividend growth, and then 6% yield, 1% dividend growth. That 1% dividend growth is really low. You can get much higher than that. At least, you should be able to get a higher rate than that. But what he's doing here is he's talking about the levers that I always talk about on my channel. If you know how much income you need based off of your anticipated expenses in retirement, then it's just a balancing act. You just kind of figure out, okay, I have X amount to invest. How much do I need to generate? And what yield do I need, and how quickly should that yield be growing? And so if you're looking at that holistically for your overall portfolio, that's the winning approach to retiring off of your dividend portfolio, is understanding this balancing act and making it work for you at a reasonable rate or reasonable risk that you're comfortable with. Now I know what you're thinking. Nobody can expect to get 30% dividend growth from their portfolio year in, year out. And you're probably right. I also don't think that a 4% yielding portfolio growing at 12% isn't realistic. SHD has entered the chat. However, 6% yielding portfolio growing dividends at a 1% rate of growth is more realistic and definitely feasible. Absolutely feasible. You can get a 6% with over a 1% growth rate. Absolutely. The highest yielding portfolio I usually suggest investors create is with a 6% yield. The reason is quite straightforward. Sure, you can try to manufacture a portfolio with a 8 or 9% yield, but you'll be sacrificing quality and reducing the number of stocks you can include. Yes, there are some quality 8% yielding stocks. If you target a 6% yield, however, you could combine an 8% stock with a 4% stock and get an overall yield of 6% or 6% yield. That is absolutely correct. And that's how you want to look at this. If you're having a portfolio, you want to look at the overall weighted average dividend yield and dividend growth rate and not just the individual positions. Very, very, very straightforward. Great advice here from Sam. This offers more flexibility. Empirical experience has shown me that 6% is the highest reasonable target to still generate good results as a dividend investor. Tom is quite happy with these results, and it has shown him as it has shown him that there is in fact a path towards retirement and living off dividends without having to sacrifice his principal. When he passes, he'll be able to leave his kids something to give them a leg up. For the sake of proper planning, Tom decides to look at a few what ifs. What if he retired 3 years later? If he chose to retire at 70 rather than 67, he could reach his income target with a lower yielding portfolio, which would then, because it's lower, it's the lever, lower yield, higher growth rate. So, it's kind of a balancing act, like I said. He could reach his target by investing in securities that yield 4% and grow at 5% per annum, or that yield 5% and grow at 1% per annum. This is a safer road, but Tom decides against it. He has been working hard, and while him and Linda are still healthy, he wants to enjoy some quality retirement time. Okay, what if they manage to scrape another $500 together to save each month, but still plan to retire in 7 years? He could reach this target by investing in a portfolio which yields 5% and grows at 3% per annum. This affords only marginally more flexibility regarding stock selection, yet would require a handful of sacrifices for the next 7 years, which he once again decides against. Tom decides he'll stick to the original plan. He'll make use of the brokerage window in his firm's 401k to self-direct his investments and invest in a portfolio with a target yield of 6%. Can such a portfolio do well? One question many investors have regarding high-yielding portfolios is whether or not they can actually do well relative to major indices. My experience is that they can do very well if you approach portfolio management investment in a smart, conservative, opportunistic way. The Dividend Freedom Tribe's high yield portfolio has capital gain returns of 42% versus the S&P 500. So this is their own personal portfolio that they talk about on Seeking Alpha. You might think this means that it is a worse portfolio, right? Wrong. Dividends are of course a very important factor of total returns, especially with a higher yielding portfolio. Since inception, the high yield portfolio has returned a total of 77% versus the S&P 500's 57%. Okay, so this is what they talk about on Seeking Alpha. Okay, that's cool. So yes, it is very possible for high yield portfolios to not only keep up with the market, but do better than it over time. I do not suggest buying a dividend ETF when you're planning to retire on dividends, as these do not offer the degree of flexibility in crafting the yield and dividend growth targets we require to succeed. Now, if you're watching and not just listening, you'll notice that I have this marked here in red. Now, I have this marked in red. When I read this, I was like, wait, hold the phone, wait a second. You're telling me. So once again, coming back to the audience that we're discussing here, we're talking about a 60-year-old who has not invested previously, who is a newer investor, a newbie investor, to quote the article here. Why would you recommend a newbie investor actively pick individual stocks and to manage individual stocks, something that they've been unable to do their entire life? Why in the heck would you do that? Why in the heck would you think that that's a good idea? And so, as I mentioned in the beginning of this article, there's a lot that I like about this article. There's a lot that I dislike. And this is what I absolutely dislike. This is, and in my opinion, I think this is irresponsible and dangerous to every 60-year-old watching this video or reading an article like this, making you think or feel that you're going to actively pick the right stocks and you're going to be able to manage that, where your entire life before you haven't been able to do it. I just think it's irresponsible and dangerous for anybody in this situation who we're addressing. We're talking about new investors to advise something similar like this. I believe that I like Sam and Robert, but I do strongly believe that there is an alternative motive to this article, and it's to get them to sign up to their Seeking Alpha investor group and to get access to this portfolio. Hey guys, our portfolio outperformed and we're going to recommend you do that. Don't buy low fee index funds. That's bad. Wall Street has always made it feel like it's harder than it has to be. If anyone tells you to not invest into ETFs, your alarm bells should be ringing that they probably want to sell you something. They probably have an alternative motive. They want to put your money into their pocket, okay? And so when I read this, I was just like, no. I got to drop the hammer on this. This is just dangerous and irresponsible. So after that healthy little rant, let's continue reading the article. What's more, since the inception of our high yield portfolio, the Schwab US Dividend Equity ETF SHD, which is a crowd favorite, hasn't really done so well, with a total return of 42% underperforming the S&P 500. So once again, he's comparing their high yield dividend portfolio versus SHD. So there's their motive. They want you to invest into their approach. They want you to sign up to their Seeking Alpha investing group to get access to their high yield portfolio, which is outperformed the market, right? Promising outperformance. That's I've never heard that before. And the audacity to bash SHD, my beloved SHD. Man, to each their own. But if you're 60 years old, I would give you a word of caution to, when you read stuff like this and when you're in a vulnerable situation, when you're scrambling and late to the game and you read an article like this, just remember, put on your thinking cap, your alarm bells you should be very reserved and be very cautious what you do. And I'm not saying that my way is better. Maybe I might be implying it with my video here, but I don't believe my approach is the best. It works for me, but to insinuate that you should recommend to a new investor to invest in individual stocks, I think is just mind-blowing. So anyways, let's continue here. How is this possible? So how are they going to outperform the market with their high yield portfolio? Let's hear their secret sauce. What's their secret sauce? Doing better than market over time takes a handful of skills. They got skills. They're going to sell you some skills. Okay, so what are your skills to outperform the market? The first is patience. You can't be in a rush. Certain things just take time. The second is temperance. You can't be hot-headed. The third is knowing what actually drives returns. There are essentially four things which drive returns for equities. The first, quality, value, growth, and momentum. Quality refers to buying businesses with durable competitive advantages, good management, and nice balance sheets. Classic Buffett and Munger stuff. That's great. Sell them the illusion that you can do it and reference Warren Buffett. I've never seen that before. Oh my gosh. Value refers to buying these businesses for less than they are worth. Growth refers to whether or not the business is growing at a fast enough rate. Momentum refers to the price action of the stock. The first three drive long-term returns. The last one draws short to medium-term returns. Quality is a non-negotiable. Don't dabble in bad quality stocks, and you've solved a big part of the equation. Yeah, dude, don't buy the garbage. Don't buy the bad stocks. Only buy the good stocks. Don't buy all the stocks that are going to go bankrupt. Obviously, just buy the good ones, right? It's easy. Just buy the good ones. Now let's go and let's see their example of buying the good ones. One common pitfall is to fail to see the erosion of a competitive moat due to changes in the competitive landscape. Wait, so you're telling me somebody that's 60 years old is going to have the ability to have foresight over what company's competitive moat is going to go down and erode before it actually does? You're telling me that? Or are you telling me that you're going to tell them and they should pay you to do that? I don't know. Let's continue reading. I'm curious. So Amazon, for example, has single-handedly use Amazon, one of the best companies in modern history. We'll use that example, and then we'll quote Warren Buffett. Great. Distributed multiple industries over the course of the past 2 decades. This has permanently eroded the moat of certain companies and in other cases has increased pressure. For instance, retailers like Walmart and Target were forced to adopt digital strategies due to Amazon, as were grocers like Kroger once Amazon acquired Whole Foods. In pharmacy, Amazon's entry has totally eroded the moats of CVS Health and Walgreens. As you can see in their DFT charts below, it's not going great for them. This is why individual stocks are so hard. These are great companies until they're not great companies, okay? And let's keep going. In transportation logistics, UPS has failed to deliver on its post-pandemic promises due to pressures from Amazon. Okay, so cherry picking some examples here. Yeah, sell the bad companies and only buy the good companies. You need to go back in time and buy Amazon back in 2002, 2003 when it bottomed. This is why it's so hard to invest. This is why it is so hard if you're new to investing. You read stuff like this, it confuses and misguides the crap out of you. I read this, there's some great stuff in here, but the main focus of what they're trying to tell you to do is just so misguided for who they're talking to. Maybe if you have like an MBA or if you have a finance degree, yes, this is a great approach, but you're talking to new investors. And that's why I mentioned this is so irresponsible and dangerous for somebody in their 60s to go and pick individual stocks on their last hurrah in life. And I think the reason why I'm getting so angry about this is I'm thinking about my parents. If my parents, they're not in this situation, but if they were 60 and saw an article like this and then put all of their life savings into single stocks, I would just be so angry that they did that because it would be so irresponsible. I would just be really, really sad. So that's kind of what I'm thinking about and why I'm getting so worked up on this article, because hopefully you can hear it in my voice that this is kind of making me mad, actually, the more that I read it because of how irresponsible it is. But Yeah, so quality matters and it's not black and white. Don't sweat it. Though you're bound to make mistakes, all three of the above were bought by myself and Robert and sold at a later date at a loss. Truly assessing quality is one of the hardest parts of this game. You'll get it wrong sometimes. The important thing is to bail once you realize you're wrong. Okay, all three of these stocks are now considerably lower than when I chose to exit. Growth and value are like two buckets in a well. Give me more of one, I need less of the other. This should be clear from the dividend yield and growth combinations of the sections above. A higher yield means I can deal with the lower growth, especially if that's a higher yield relative to historical standards and that quality and growth prospects remain unchanged. Value provides a one-time increase in price when the stock gets re-rated to historical levels when the pendulum swings back. Philip Morris is a great example of this. The pendulum swung, creating value in 2018 and then stayed deeply undervalued until 2021, a period I now call peak woke. Then in 2024, the market woke up despite giving us hints here on Seeking Alpha for years, and the valuation corrected. Big win for us as PM is a large position of our portfolio. Congratulations, bro. The stock went up. Growth, on the other hand, provides the backbone for long-lasting appreciation in capital and income. The Home Depot DFT chart below shows this. Sure, HD has gone up and down, but the chart is skewed up due to the strong backbone of growth from this company. Finally, momentum provides that spur which pushes a stock up after a period of nothing. Our bare bones momentum indicator is a crossing with the 200-day simple moving average. Yeah, we're going to talk about 200-day simple moving averages to newbie dividend investors who want to live off their dividend investor. We're talking about simple moving averages. Great. This is a good way of assessing that a downtrend might be over and it might now be time for it to appreciate. Two stocks which I'm excited about here that could very easily fit into a high yielding portfolio like the one Tom wants to build would be Pfizer and Bristol Myers, which have both come out of a period of undervaluation, in my opinion, and are some extremely high quality pharma giants and have great pipelines of future growth and are now crossed their 200-day simple moving average. Bravo. You're recommending to a 60-year-old that they buy Pfizer and Bristol Myers over SCHD in a dividend ETF. If you can't hear that, that's me clapping my hands, just furious that the fact that you'd have the audacity to write something like this. The reason why you're suggesting this over SCHD is you have an incentive to sell something. The fact that you're saying to buy this over SCHD, it just blows my mind. I just cannot believe this. I am just in shock. So let's read the conclusion here. Our simple motto is to buy low, sell high, get paid to wait. The slightly longer, more accurate version would be something like this. Focus on the highest quality companies, which have sufficient growth for the value they offer. That gives context to what low and high actually means, and which are showing positive price momentum. Applying this framework to dividend investing with proper personal financial planning, I believe that anyone can retire on dividends, even if they get started late. When there's a will, there's a way. Okay, so that's the article. Let's take a look at a few comments. The first comment here, I owned Lockheed Martin, Hershey's, Exxon for over 40 years. Their dividends feed and water my family. Start early and keep investing. Boeing stopped their dividend. That said they didn't love me. Pushed the sell button and pushed the buy button on JP Morgan. They pay me over $6,000 a quarter and raise it a tad every year. It's not rocket science. It gets to be fun. Yeah, I mean, this is great if you did this 40 years ago, but what about the person who is 60 years old that's just starting now? Like, that's great that you did that, but you know, for somebody that's 60 years old, you're in a completely different dilemma. So yeah, that's a great comment, but not for those of you who are 60 years old looking to retire with little to no income, like little to no money invested. So yeah, I mean, yes, the moral of the story is go back in time and start earlier. Okay, great. And also buy stocks when they went down and only buy them when they go up. And then only talk about them when you did the right thing, right? Great article. I've been in the market for less than 10 years. I'm in my 8th decade on this planet. My first stock purchase was Procter & Gamble for around $76. My second was Microsoft. Cost basis on it is 66. I currently own one ETF, SCHD. An 80-year-old owns SCHD, man. High five. That is awesome. And 13 individual stocks. All my stocks pay a dividend. All but one has raised their dividend every year since purchase. The dividends and dividend increases have definitely added up over the short time I've been investing. So has the price appreciation. My only regret is I didn't start sooner. Another comment here, many 401k employee matching accounts don't allow for DRIP. If you're 59 and a half, you're better off rolling all or some over to a self-invested IRA, then choose your stocks ETFs that allow to compound DRIP. This is such a great comment. This is so important. Whenever you quit your job, one of the first things that you want to do is make sure that you're rolling that over or converting it into an IRA or a Roth IRA. Just be very aware, if it's a traditional IRA, will be taxable in the year that you roll it over or you convert it. So be very, very mindful of that. If you have a sizable amount in there, you want to make sure that you kind of have a plan in place for taxes so that you're not doing it all in a single year so that you can spread out the tax burden. And spoiler, if you're invested into a Roth 401k and your employer is contributing, they're contributing to the traditional portion of it. So your contributions will be, tax-free because it's a like-kind rollover, Roth to Roth, but your employer's contributions will be taxable if you convert it into your Roth IRA. So be very aware of that. And the last comment here, it's my belief that investing in higher paying good companies to get cash now is far better than opting for low dividends and hoping a company may grow in value later, especially when starting later in life. Yeah, I think, I can't say how many times I've said this, but it is a balancing act, right? Like you want to find that good mix of we're getting a reasonable starting dividend yield at a reasonable risk, where you're comfortable with, and you want to make sure that you're focusing on how quickly that yield is growing. And if you're retiring, now or in the near future, you're obviously going to want to skew more towards a higher yield today and sacrifice on the growth going forward. And it's completely flipped upside down if you're not in that situation where you have a long-term time horizon. And that's why over these last couple of years, so much of my content on YouTube has been focused on how to invest based off of your investment time horizon, because that is one of the most important things when it comes to wanting to retire on dividends forever, right? The title of this article, it really truly comes down to understanding how to invest based off of your investment time horizon. So that's the article. I'm going to give the article a C-. The reason why I'm not giving it a D or a D+ is because not everyone has the same strategy as I do. Okay. And I know that there's plenty of investors out there who want to invest into individual stocks. I guess the beef that I have with this article is you're addressing new vulnerable investors who are at their last sprint at life and they can't mess this up. And if you're recommending that they invest into individual stocks based off of growth, value, quality, and momentum, and to look at the 200 simple moving average, I think you missed the mark here. And especially like for who you're addressing. If this was addressing, experienced, affluent investors who know what they're doing, then yeah, this absolutely could work. But this article is tailored towards newbie investors. And I find it to be incredibly irresponsible and dangerous to advise someone who is a newbie investor in a way like this. The fact that he said he doesn't recommend dividend ETFs, he lost me. When I saw that, I was like, you are insane to recommend that. And I just was like, my alarm bells were going off like, why would he recommend that? There's no reasonable reason to recommend it other than they probably have an alternative motive. They want to put your money in their pockets with you investing into their investment group. Did you all also notice they only talked about their winners? They talked about their portfolio outperforming, but didn't really give any details about how to retire on dividends forever other than talking about this 200-day simple moving average. Like, give me a break. So that's the article. Those are my thoughts and opinions. I'd love to hear your thoughts. Do you agree with me? Do you disagree with me? And yeah, thanks for watching.